Absolutely delighted to have Dave Waters here with us today. He is the president of Alluvial Capital Management. Since 2014, Alluvial has focused on finding opportunities in obscure, overlooked, and misunderstood securities around the world. He launched the Alluvial Fund in 2017. The fund has had a remarkable 18.4% annualized return since inception. Alluvial grew out of Dave's well-regarded investing blog, otcventures.com, and prior to launching Alluvial, Dave worked for Willington Trust and New York Mellon. Thank you for joining us today, Dave.
Thanks for having me. Happy to be here.
Excellent. It's a pleasure. So excellent. Yeah, so let's begin with the presentation.
Very good. Give me 1 second here to share my screen.
Great.
Okay. Are we good?
Yes, looks great.
Great. Then I will get into it. So once again, happy to be here today. Thanks for having me. I'm looking forward to talking a bit about what it is I do at Alluvial, which is somewhat different, but has been extremely rewarding, and it is a ton of fun as well. So I titled the presentation, Investing in the Odd, the Unusual, and the Obscure, which sort of describes my investment approach from beginning to end. So I will get right into it. A little bit of background on me, which thanks for the intro, it was great. I'll try to skip over anything you already said, and we'll keep going. Like I said, my name is Dave Waters. I founded Alluvial Capital Management in 2014 because I had a strategy that I loved running, loved researching, and thought that I'd be able to offer to anyone who was interested. And so I left the bank and got going in 2014 as an RIA. I did launch a pooled vehicle a couple of years later, and that's been a ton of fun to run as well. So hard to believe we've been going for 8 years now. The time really flies, but it's been a blast and it's been a wild ride. Before I launched Alluvial, I had work experience at BNY Mellon and Wilmington Trust in the wealth management department. But turns out that big trust banks don't really like to do microcaps and liquid securities and weird international stuff. And so I needed to go off on my own to really offer what I had. The practice grew out of a blog that I launched in 2012 called OTC Adventures. At the time, I was writing about my finds of opportunities I ran across, mostly on the OTC market in equities, but that expanded later to cover just general small companies and also international stuff as well. The blog got a good reception from the get-go. That's how I got really about all my clients, especially at the beginning. I've now transitioned over to alluvial.substack.com. I don't write as much as I used to. I'm a much busier guy today, but I try to share some thoughts now and then. So check it out if you're interested. From the beginning, I started off very, very small. I think when I launched in early 2014, I had about a dozen clients and just 2 or 3 million under management. So it was really starting on a shoestring, but I didn't need much. I was one guy sitting in my cheap apartment. And so it didn't cost much to run the business, and I was able to get started that way with the idea that if it grew, fantastic. If not, well, at least I gave it a shot, and I wouldn't have any regrets. But today we've grown pretty significantly, and we manage around 50 million in discretionary client capital, and it's me and I have an associate, Tom, who's been with me for 4 years and does a great job. So let's see. And the big question is, why this strategy? Why would anyone choose to focus on weird, obscure stocks and securities that nobody cares about and nobody's interested in, and they never show up on the Wall Street Journal or on CNBC or Bloomberg? And basically, what's the attraction? Why is this interesting? Why does it work? And why do I like doing it? Well, tons of reasons, and the biggest one is that's where I'm able to find an edge. Essentially, as just a guy with one associate, essentially doing my research by reading financial statements and talking to companies and putting together my own models, it behooves me to look in places where there are few competitors. I know that I am not smart enough or capable enough or have enough hours in the day to develop a variant viewpoint on stocks that are huge and have exceptional trade and liquidity, because I know I'm competing against dozens upon dozens of analysts and market participants who are more sophisticated and have more resources than I do. It's just not going to happen. I'd be kidding myself to do that. But I can develop a better thesis than the average market participant in stocks and securities that are small, have very limited trading liquidity, or trade on a strange exchange somewhere that gets little attention and is somewhat stigmatized. And so that's what I do. That's where I've been able to find great ideas, and I hope I can keep doing that. But it's just in general, I'm trying to take advantage of the illiquidity premium, which if you look is actually better supported in academic literature than the small cap and value premium over time. And it just makes logical sense. Like I said, the fewer market participants, the larger the percentage of market participants who can't invest in something, the less likely it is to be efficiently priced. And so I'm able to find more opportunities in stocks and securities that can't accommodate large pools of capital, because I'm not really running a large pool of capital. I mean, we're running 50 million, but in the context of the investment universe, we're just a minnow. We're tiny. We hardly exist. We're a speck. And I like it that way, but we have to invest differently, and we do invest differently than a huge fund or mutual fund ever could. So that brings us to the question, all right, so you say you invest in these securities, but what actually are they? What do they look like? What is the typical sort of opportunity or that goes into your watch list or into a client portfolio? And it's often, but not always, small companies, small caps and micro caps. And I really do mean micro caps. The average enterprise value of a company that we hold in our portfolio is right around 100 million. So yeah, these are really, really small companies, the very, very bottom of the public company scale. And these companies are just uninvestable for large pools of capital. I mean, a large mutual fund, 5 million, a 5% position in a company that size, if the market cap's 100 million, it doesn't move the needle if you're running a 5, 10, $20 billion portfolio. So there's no point in them looking there, but I will. Also, just general low float securities. There are securities and companies that have enterprise value market cap in the billions, but maybe 85 or 90% of the shares are held by just a few insiders or a couple of hedge funds. And so the security trades as if it's a totally off the run microcap, because maybe there's only $100 million of stock that's tradable for the average investor. And so those can get mispriced as well, especially in places like Europe. We also participate in a lot of special situations. Liquidations are fun. We do bankruptcy and reorg securities, mergers too as well, because the very large sophisticated players in those markets can't really do the very small end of the scale, again, because it doesn't make a difference, doesn't move the needle. And we also love to invest in difficult to access and unfamiliar exchanges. A lot of the times that's the US OTC markets. There are thousands upon thousands of securities there. The majority are garbage, but you can sometimes find some really great stuff there. I love to look in the junior segment of foreign exchanges, because that's just a market that goes overlooked. There are well-known international blue chips that American investors will buy from Europe and places like that, but very few American institutional investors look at the junior segment of the London Stock Exchange or the Borsa Italiana or the First North segment of the NASDAQ Nordic. Places like that can be great sources of ideas. So yeah, love to look there. And there's also some very interesting semi-private markets that function almost as bulletin boards, where buyers and sellers just need to exchange stock, whether it's for a small bank or there's some agricultural companies that trade this way. And I won't talk too much about that because I can't give away all my secrets, but those can be fun places to invest in securities as well. Caveat being, as always, that the liquidity is poor. And if you want to get in, you might have to be in for a while. And like I said, this sort of gets into our hunting grounds, and the OTC market is fantastic. It's the market's thrift store in a way. And what that means is you have to search through a ton of total junk. and garbage to find those rare opportunities that are quality companies that are investable. There are a lot of quality companies that trade OTC just because they don't see the value in paying the exchange fees to be on the NYSE or the NASDAQ. They just never have, but it's not appealing, but they do want their stock to trade, and so they trade over the counter. A lot of companies trade here after bankruptcy. Their stock will pop up on the OTC market and trade there for a few months while they work on uplisting to a major exchange. And there's just a lot of really, really fun stuff there. And there's also some really, really wild stuff. Just one example, for a couple years there was a company called Bigfoot Project Investments that traded over the counter, and they were literally looking for Bigfoot. And they've gone inactive. They're no longer there. So I guess they never found Bigfoot. But yeah, wild stuff like that. It really is the Wild West. Any tangentially, marginally viable business idea can trade over the counter. And so that's what gives it the bad reputation. But for every Bigfoot company, there's a company like a Burnham Holdings, which does HVAC and boiler heating equipment in Pennsylvania. Or there's a Computer Services, which is actually a phenomenally successful Kentucky company that does core processing systems for banks, which is a really, really good business. It's very sticky. It grows over time, and they buy back a lot of stock, and they make a ton of money. But they've always been over the counter. But they've done phenomenally for their shareholders all the time, over time. Also, there are hundreds of community banks that trade over the counter. There used to be a lot more. There's been a lot of consolidation in that market, but these do trade, and they are not the world's most exciting companies, but they are by and large profitable. A lot of them buy back stock or distribute capital in other ways. And now and then they get really cheap. And there's a lot of buyout activity there too. So if you can find a company, a bank that trades cheaply and is a good buyout candidate, you can make a great return over a few years investing in those markets. OTC stocks, a lot of them are SEC filing, but some of them are not, have deregistered, and they just report their results through the OTC service or on their own website or something. And so, buyer beware there. You have to do your diligence to make sure that the company is legitimate and that the financials are reliable. But there again is the opportunity. If you will do the work, you can find the opportunity. And yeah, continuing. Foreign exchanges, like I said, US investors, it's a worldwide phenomenon, but we have a really intense home country bias, and a lot of it makes sense. I mean, the US is a fantastic market for companies and investors, and US markets have, especially over the last few years, have sort of radically outperformed other markets. And so it makes sense that people put so much capital there. But I do think that if you're really looking for undiscovered opportunities, it makes sense to look overseas as well, especially because a lot of these markets don't have the same number of private equity bidders and activist investors looking at these companies all the time. And so, yeah, there's opportunity to get in before the market wakes up a lot of the time. And a few economies that I've had particular success in and enjoy looking in are Sweden, Italy, Australia, Poland. They all have really, really robust economies that provide a really robust environment for small cap and micro cap companies to go public. They've sort of taken like a reduced regulation approach that encourages some of these small companies. And that's one reason that so many small companies in the US have chosen to go private or to delay listing, is because our regulatory environment is somewhat onerous for a small company. I wish we could figure out a way to reduce some of that burden for smaller companies, but meanwhile, other economies have figured that out and have created environments where really tiny companies can go public and access public capital, and it's a fun place to look. Valuation methods. People often ask me, well, you look in these markets and how do you find the bargains? And I tell people all the time that I'm no wizard. I'm not really a revolutionary who's totally upending traditional valuation theory. The usual approach is work. DCF, scenario analysis, relative industry multiples, and residual value. If it's a legitimate, recognized approach to valuing a company, it works in these companies as well. You just have to insist on a larger margin of safety and discount relative to the larger liquid securities, because you have to get paid for buying these securities that you might have difficulty selling. And a lot of them just trade at a discount for a long, long time, and you have to be willing to accept that. And so really what I do is the exact same thing that any other securities analyst was doing in larger companies and more liquid markets. I'm just applying it on a smaller scale and insisting on a larger degree of margin of safety. I've talked a lot about some of the advantages to this approach. I'll get to the negatives next, but for now, a few of the things that I love about looking at these small companies is, well, number one is the access. A lot of these companies get no attention from professional investors or really investors of any kind. And so they love it. They roll out the red carpet if you actually reach out to them. Typically, when I'm searching for a new opportunity, if I find a company or a security that catches my eye, an email or a phone call can have me on the phone with the CEO and the CFO in a few days. And I can talk to them in a way I would never be able to talk to C-level management at a large company except on their investor day or something. So that's really cool. I can get to know these people and talk about their businesses and ask questions. And I'm not looking for any information that isn't public, but I do want to know their backgrounds, their thoughts about the industry, their thoughts about their competitors, and just general, get a sense of how ambitious they are and how dedicated they are to the industry, and just how savvy are they. And that's important for these small companies that are so personality driven and so people driven. And every company is just people, but I find large companies often have an institutional culture, but for small companies, the culture is typically 2 or 3 people. And what the things those 2 or 3 people believe in and think, and their opinions and their strengths and weaknesses have a profound impact on the performance of the business. Also, a lot of these businesses are just simple, which is pretty cool. A lot of them have only a single product line or segment, and the financial statements, I mean, the annual report might be 50 or 60 pages, maybe even 30 pages, compared to an S&P 500 component, which might have a 200 or 300 page annual report. So these businesses are much, much easier to analyze and evaluate. That's also a risk factor, right? If you're dependent on a single line of work or a single product, you're more vulnerable to changes in your industry, but it does make the businesses more easy to analyze. And again, going back to just the limited competition. Every large business has a whole fleet of people watching its every move and analyzing credit card data and looking at satellite images of parking lots for retailers and things like that. And nobody's doing that for these little companies because the opportunity is just so much smaller. It doesn't make sense for them to spend that money. And of course, there are the drawbacks to looking at these small companies. They say that sunlight is the best disinfectant, and basically that just means that companies that people are always looking at and tracking their every move have a hard time getting away with the, call it shenanigans, that I see some of these small businesses doing. These small companies know that a lot of the time they can get away with stuff. And so you can often have management teams and boards of directors that are deeply conflicted. They're siphoning value from the company, they're overpaying themselves, there's related party transactions that no truly independent board would approve. And they can get away with it because they know that no one's paying attention. A lot of times their investor base is disinterested or gave up on the company a long time ago, and they just get no attention. And also they know that it's unlikely that activists will come in, but there are a few very talented, dedicated activists in the small cap, micro cap space. But in general, the activism is difficult and the reward is poor. I mean, you might spend $500,000 on an activist campaign, and if it fails, you're out the money. But if you succeed, maybe you get reimbursed, but maybe you made a couple $1,000,000. Compared to the risk reward for doing activism, large cap companies where you might make a couple billion if you succeed for all that work you did. And so it's tough. And then of course, the fact that I touched on earlier, these small companies often have much more limited financial resources. They attract capital on much less advantaged terms than their large competitors. They often have a lot more supplier and customer concentration and can be vulnerable if they have a hiccup from a supplier or if they lose a large customer for some reason. And just then the management team is frequently less professional and less experienced than their large company competitors. Not always. There are some really talented, really experienced and motivated, bright people working in these businesses, but overall, management quality is lower. And then you're often dealing with a lower level of company disclosure, especially for companies that may not be SEC registered. You don't get the full footnotes disclosing every material fact that you're supposed to get for large companies. And so you have to dig a lot more and ask a lot more questions of these businesses. And you just can't rely on their disclosure as published. So I'd say what it takes to succeed in a market like this is, and the first thing is patience. You can't buy these companies thinking that you'll make a lot of money and you'll outperform your index all the time, or that the company will get to its fair value in the next 3, 6 months, even a year. If you want to buy these companies, you have to be willing to wait for the market to come around to your point of view, unless you're sort of a dedicated activist. That can be really, really frustrating. I mean, a lot of times I find an attractive situation and I buy in and I see the company do everything right and the market just doesn't care for a long time. Or maybe there's a seller who has a block of shares the seller's trying to get rid of, and the stock's just not going to move until that seller is done, and maybe the stock even trends down in the meantime. But if you buy right, if you do your analysis correctly and you accurately assess the talent and the motivations of the management team and the quality of the business, and you buy at a sufficiently attractive price, eventually the market comes around. Either investors just find the company, or they choose to sell, or they do something value creating like a tender offer or a leveraged dividend or something of that nature. Eventually the market comes around. Rarely on the time frame I would prefer, but it does happen. And also, I have to say, you have to recognize that just because a security is tiny or it's illiquid or it's little known or off the run, that doesn't automatically make it attractive. There are a lot of companies that have become very obscure and are little known and get no respect from the market for very good reason. They have a history of burning capital, the management team is not trustworthy or adequately motivated, or there's real terminal value risk. The business faces obsolescence with its products, and some companies are just fail all the time because it's the people or it's just a tough industry. And you have to really watch for those, because the worst thing you can do in a situation like this is buy a ton of shares, a ton of securities, wait around, realize you were wrong, and then have to sell into a really illiquid market. You will not get the price you want. You will push the shares down, and it hurts. And no one's perfect. It will happen to you if you invest in a market like this. It happens to me. But my task is to make this happen as little as possible, because that is the worst outcome in a market like this. And you really have to be committed to doing an enhanced level of diligence, because like I said, if you're in, you're going to be in for a while. If you change your mind, you can't turn around and sell everything tomorrow or this next week. It's not easy to do. So you have to be really sure you want to own something and sure that you'll be able to hold it to maturity, essentially, before you buy in the first place. Yeah, and so just for fun, I thought I would talk about a few examples of what I would term these weird stocks I like to look at. I don't own any of these at the moment. I'm not saying and they're good or bad. And if I mention a stock, I'll tell you if I own it or not. I don't own these. But these are just a couple examples of the unusual business models which you see in some of these small companies that really don't exist for large at-scale businesses. One of them is Jungfrau Bahn, which trades in Switzerland, and they own Alpine railways, which will take you to the top of the Alps. So you can access chalets and skiing areas and just general tourist stuff. And I like this business because it has incredible barriers to entry and thus pricing power. These railways were largely built about a century ago, and there is no way the Swiss government will let anyone build a brand new railroad up the side of a pristine alpine mountain for environmental reasons alone. And so they've done well over time. They have pricing power, but of course they are cyclical and they depend a lot on tourism activity. Another really interesting one is Mills Music Trust. This is a trust that trades over the counter that owns the royalty rights on on hundreds and hundreds of songs, mostly written in the mid 20th century. As is typical for a royalty trust, only a handful of songs generates the vast majority of the royalties. But some of these are pretty well-known holiday season songs that you'll hear on the radio. So yeah, you can pull up the financial filings they do file, and you can take a look at a couple of the songs they own. You'll be like, oh yeah, I know that one. And then you'll see songs that have not generated royalties in decades that literally no one doesn't play anymore. The Mills actually comes from the Mills family. Heather Mills, who Paul McCartney married to, and Paul McCartney has actually been a shareholder or unit holder at times in this trust. I'm not sure if he still is, but so there's sort of a celebrity attachment there. Tivoli is the famous Tivoli Gardens in Copenhagen, a tourist area. And so this is a bit of a novelty stock. They definitely don't attempt to maximize profits or whatnot, but it's just interesting that a major cultural area and major tourism attraction actually does trade. You can buy shares on the Copenhagen Exchange of Tivoli. And some of these companies actually give discounts for shareholders. I'm not sure if they do or not, but it's worth checking out if you plan to visit. Maybe buy 100 shares and maybe you get a discount on your ticket. I don't know, maybe that's them. Philly Shipyard is an interesting one. It's majority owned by a Norwegian sort of energy conglomerate, Aker. If you ever have driven south of Philadelphia on I-95, sort of just north of the airport, and you look to the east, you will see a shipyard that says Philly Shipyard. And at times, not always, but there'll be a ship there that they're constructing. This was formerly operated by the Department of Defense. This shipyard produced a lot of warships in the 20th century, but fell into disuse and was obsolete. But the state of Pennsylvania struck up an agreement with Aker that they would come in and operate this shipyard. And so yeah, it's just a single shipyard. I go to Philly now and then. I'd always like to look and see what they're working on that day. And then sort of another little weirdo I have here is Parks America, which trades over the counter and operates wildlife parks, one in Georgia, one in Missouri. And this is the sort of thing where you pile in your car, you buy a ticket, and you drive around, and they have zebras and giraffe and, I don't know, water buffalo or something that you can look at. It's sort of like a zoo, except you're in your car. And as you can imagine, they did very, very well during COVID, because it was a pretty COVID safe activity to sit in your car and drive around and look at animals. So just the sort of oddball amusements business that you would never see on the NASDAQ or the New York Stock Exchange, but you can find over the counter, and they've been pretty successful over time. I think they just bought some assets from a new place in Texas or something. But yeah, it's a big world out there. And I would be really bored if I could only look at the S&P 500 components or the NASDAQ, top 100 or whatever. So yeah, I have a ton of fun looking at these businesses, and a lot of them are not attractive, not cheap. They're nearly always interesting. And so I spend my days trying to find the next opportunity in places like this. So yeah, that's a brief overview of what I do, my approach, and I'd be happy to answer some questions.
Yeah, I thought that was a really terrific presentation and very insightful, especially for students who I think typically are managing less capital in their sort of own personal accounts, a very small amount usually. Can you talk a little bit more? So you talked a lot about your investment philosophy, but I would imagine, if you look for, let's say, companies that have, let's say, the relatively low liquidity in, a lot of these markets you discussed, you're still probably going to have at least several thousand, if not 10,000 companies, I would imagine. So how do you narrow down the list further? Are there different parameters that you use, and maybe you can share some of those with us? Or do you sort of just do what Buffett used to do, where you basically just start with the A's, go to the Z's, then cycle back to the A's?
I do a little bit of each, honestly. I mean, I do take that brute force method approach a lot of the time because these companies, they oftentimes don't screen very well. Either the data doesn't come through very clearly, or the data is not picked up in real time by some of the services that are out there. And so there's really no shortcut a lot of the time than by reading about them. And sometimes in note 12 with a financial statement or something, you'll see, oh, after the quarter ended, they sold a warehouse for 15 million or something, and maybe the whole enterprise value is 60 million. And so that's hugely material information that sometimes they don't even put out a press release on, which is kind of incredible. So you can find stuff like that sometimes. But I also do employ some screens because you're right, with thousands of securities, I have to find a way to eliminate a lot of them at a time and get it down to a manageable list. And so maybe I screen for things like return on capital and improving margins and free cash flow yield and things of that nature. Just sort of the general highlights and attractive data points in the value world is pretty effective in finding ideas.
Yeah, I think that makes a lot of sense. I mean, what sort of area do you typically tend to find most of your ideas? Is it usually things that have, let's say, a high free cash flow yield? Is it usually things that are trading at a discount to assets on the balance sheet, or even assets that aren't really realized on the balance sheet, like real estate that's recorded at historical cost but is worth much more today? Is it more companies where you feel like they're at a decent valuation, maybe not really lowly valued, but a decent valuation, but they have a good sort of growth runway ahead? Where do you tend to find most of your opportunities?
Yeah, I would say it depends a little bit on where we are cyclically in the market. I mean, at market lows, you can find a lot of stuff in the classic sort of Ben Graham bucket where, it's discount the net current assets or whatnot. But I would say over time, my best ideas have come from situations where the market is just sort of misclassifying a company, where I find a company and maybe it's trading at 8 times current earnings, but I can see a very achievable high probability path for that company to grow its earnings by maybe 50% over 3 years. So essentially, I want to buy a company most of the time where I'm paying a very low multiple for its current earnings, but I feel very confident that those earnings can grow significantly. And so essentially, a growth stock that's priced as a value stock is kind of my favorite opportunity.
Yeah, I think that makes a lot of sense. And you spoke about how sort of investing in the space requires a greater margin of safety. What sort of minimum margin of safety are you typically looking for?
Honestly, my ideal scenario is where I find a stock that is trading at $10, but I think it's worth 20 today. But I also think if the company executes well and everything goes according to plan, that in 2 years it can be worth 30. That would be the ideal scenario. But typically, because like you said, it's tough to get out sometimes once you get in, I'm not interested if it's $10, I think it's worth 12. That doesn't make any sense. I need a lot better opportunity than that.
Yeah, absolutely. And let's speak a little bit about, you spoke a little bit about caveat emptor stocks and dark stocks. How sort of frequently do you invest in, let's say, things that don't have current filings, and how is sort of the recently amended Rule 15C-211, how has that sort of affected your operations in that category?
Sure. So, well, unfortunately, despite my letter of protest and a lot of my friends' letters of protest, the SEC did adopt that rule change and make it nearly impossible for the everyday investor to invest in non-reporting companies. I understand why they did it. But these days, if you want to actually invest in companies without current financials, you have to work through a specialty broker, and it's just probably not worth the effort for most people. But there are a lot of companies that still just release their earnings reports to just right to the otcmarkets.com website. For example, I own a lot of a company called Callaway's Nursery, CLWY, which I very much do own. So do your own due diligence. But they are a Texas-based operator of nurseries and garden centers. And they're not an SEC filer. They deregistered years ago, but they do provide their quarterly and annual reports publicly through OTC markets, and they can continue to trade because they provide their financials in timely fashion. And there's still a lot of opportunity in that market, but unfortunately, the truly dark stock where they don't provide any info and you have to buy a share and call the company and say, hey, please send an annual report, that opportunity is a thing of the past now, unfortunately.
Yeah, absolutely. And as you said, a lot of times, I guess OTC screen, not just OTC screeners, but screeners for some of these, let's say, smaller or less liquid companies can have sort of some inaccurate data. What sort of platform do you use typically? Is it like Bloomberg? Is it Capital IQ? Is it Ticker? What have you sort of found to be most dependable?
Yeah, I really like Ticker. That's sort of my platform for my launching point to keep track of my watch list and keep track of news as it comes in. And I like that the financials are right there. And they're not the only solution out there, but they're a good one. And I'm friendly with the people who run it. They couldn't be any nicer than they are. And so I'm a big fan of them. I also use a really good screener called screener.co. It's just a website, screener.co. It's sort of a low tech thing, but they use Thomson Reuters data, and it's high quality, and I like them. So yeah, I think that's one of the biggest myths about about investment management is that you have to have all this tier one software that's going to cost you like $3,000 to $5,000 a month, and you have to have a fancy office. Like, no way. I mean, I run a fund on a shoestring. We've done just fine, and I think that's something people say to keep people out of the industry, because it's not an easy industry. The competition is fierce, but it does not have to be expensive unless you're trying to impress people.
And it's really remarkable to me as well that you started originally with $2 to $3 million assets under management. I mean, I've heard people say, oh, you have to have a minimum of 5, you have to have a minimum of 10. Sometimes I hear even higher numbers. So, and I know sort of, you sort of were very sort of conservative with your expenses originally, and you still are. Were you already able to be cash flow positive from 2 to 3 million, or did you sort of have to use, let's say, some of your savings at the beginning until you grew out a little bit more?
Yeah, I guess I think it took me maybe 6 months until I felt pretty confident being able to take a paycheck. But a couple things I'll say. I mean, I knew from the very beginning the strategy I was going to offer was different and unique, and so I was going to charge for it. My fees were probably a bit higher than most other strategies, because I think that's the only way to survive as an emerging manager, is to have a differentiated strategy. I mean, there's 1,000 high quality, equity long short funds out there. And a lot of them are really great, but for a new manager without much of a track record or without much of a resume coming into the business, just generic equity long short will not make you stand out. And so I had a really weird, different complementary strategy from the beginning, and I charged a bit more for it, and that helps. And I was able to back it up with returns. What you can't do is charge more and then not back it up with returns. You won't last. But yeah, so I was, and it helped that I, like I said, kept my expenses low, and I was living in a pretty low cost city, still do, of Pittsburgh. It's a little bit tougher if you're in New York or Toronto or anything, London. That's a bit tougher. But yeah, and of course that was almost a decade ago. But even today, I think you could have a viable fund if you don't have to get paid a whole lot from the get-go at 5 million. I think you could do it. I know people who were running funds at that level. If you can get to 5 million within a year, I think it's viable.
Yeah, I think that makes a lot of sense. Let's say there's students who, they're in college today, but their dream is to, let's say, maybe one day start a fund. What is sort of your advice on when is it, how do you know when it's the right time to start your own fund? And also how to raise that initial capital?
Yeah, I would say that you have to find a way to stand out a little bit. Uh, um, Frankly, I could not be where I am today without the internet. If I were 10 years older, I probably couldn't have done what I did. But at the time I was coming up, the online sort of investment blog ecosystem was going up like crazy. And it's even better today. I mean, I probably subscribe to like 50 different good quality blogs and Substacks that are out there. And they're all doing great stuff. And some people are, it's just a hobby. Other people definitely are trying to break into the industry or build a reputation. And I mean, do that. Find ideas and write about them. And I mean, I look back at some of the stuff I wrote at the beginning, like, oof, like I really missed a couple things there, but it was an important part of my journey. And no one expects you to be perfect all the time. Everyone has bad calls, but start generating your own differentiated ideas and record that and get it out there somehow. That's important. So you have something to show people that you can do research. It can be research that's not the same as everyone else is doing, and you can market that eventually. And as far as finding clients, I mean, it's not easy. I won't lie to anybody. I mean, a lot of people start with friends and family. I didn't really have any friends and family who were in a position to invest, but it didn't stop me. But it's going to be the people who read your stuff and think it's good. It'll take time. I mean, but if you can identify one person per quarter, or even maybe per month, if you're more ambitious, who likes your stuff, likes you, and reach out to that person. I would do that too. If I saw a new person sign up for my blog, and I mean, believe me, I would Google them. I would Google that email address, and if they came from a fund or had a from an MBA program somewhere, I'd reach out and it's like, hey, thanks for reading. Stay in touch. If you ever curious about these companies, I'd love to talk. So I'm more of an introverted person. I'm happiest reading a spreadsheet, but I had to force myself to do that, and it's still not easy. But it is all about relationships, and ultimately, especially as a small manager emerging, when someone invests, they're not getting a team. I mean, someday maybe, but they're getting you, and they have to like you and think there's something about you that's worth investing in. And so you have to have at least some kind of relationship with people.
Yeah, I think that's really, really excellent sort of, direction and a great framework to think about that. What about, let's say, before they sort of reach that stage in terms of, what sort of things should they accomplish previously? Maybe in one, how important did you see an MBA? Two, how important do you see a CFA? And three, what sort of, places should they be working at beforehand? Should it be more sort of hedge funds specifically? Is it just sort of asset managers in general? Is it, should they really try and do something really in the space that they're thinking, smaller companies, larger companies, your advice on those types of things?
Yeah, absolutely. And I will say that like everyone's path is a little bit different. I had one thing that worked for me, but there's a lot of ways to get into the industry, into business. And I would say that, MBA versus CFA, I have a CFA, I don't have an MBA. But I think one or the other is nearly an essential. I mean, I had an undergrad in finance, but the CFA taught me a lot of things that I never really touched on. And frankly, I don't use everything I learned in the CFA on a day-to-day basis, but it is useful. But I would have learned a lot of the same things in an MBA program. It's just about evaluating the career path you want and the dollars and cents of it, of course. But one or the other is a step that I think would benefit nearly everybody. And if you can get into to a hedge fund right off the bat, awesome. I would say do that. I mean, there's no better place to learn. I didn't have a hedge fund background. I think that's helped me in some ways and hurt me in others. I definitely could have learned some things at a hedge fund and probably have avoided a couple of my early investing lessons that cost me money. At the same time, I wasn't sort of boxed into the way that a single hedge fund thinks. I kind of had to come up with my own investment strategy from scratch, and a lot of authors and data helped me along the way, but I probably could have accelerated that quite a bit at a hedge fund. But really, I don't think there's a bad way to do it. And even honestly, some sales experience would have been tremendously helpful for me. And I didn't have any of that really. We can all talk about how much we love investing and how that's the best part of the business. At the end of the day, if you don't have at least a little bit of sales ability, good luck getting a lot of clients. So I think even if you end up in wealth management or something, which is fine. I mean, I did, and that gave me some experience of how client relationships are built and how they're maintained, and how you go about getting new clients. What, just the soft skills are incredibly important as well. So like, don't neglect that. But really, there's nothing you can do that blocks you from getting into, I mean, I wouldn't recommend going to work for a boiler room or something, but as long as you get into sort of a legitimate operation, a name you're happy to tell people you worked at, then you're fine. I mean, everyone has their own path, and you just keep working at it, you'll get where you want to go.
Yeah, I think that makes a lot of sense. Maybe speak a little bit more. So I know, you focus heavily on that over-the-counter markets. And you said you also focus more on some, secondary exchanges in other countries. Which sort of regions specifically? So I'm guessing Canada, and I'm guessing Western Europe. What sort of regions in addition to that do you look at?
Sure. I would say I mostly stick to places where there's a pretty strong body of law that backs up the rights of investors, and also have very, very good accounting standards, and that use, IFRS or some variation of GAAP. And so I feel pretty confident what I'm looking at, and I'm able to do the analysis. So you're right. I mean, I look in Canada, I look in Western Europe, France, Germany, UK, whatnot. The Nordic countries are great. Scandinavia is excellent. There's so many amazing companies in Sweden, Norway, Finland. They're all great. I've done fantastically well in Italy. That's a fun place to look as well. Australia is really good too. Because everyone thinks Australia is 90% resource companies, and that actually is fairly accurate, but that just means the other 10% goes under researched. I've done very well in Australia by finding consumer companies and industrials and things like that are not directly connected to energy and resources. But yeah, what else? I mean, Singapore, Hong Kong are really interesting, but you run into a lot of corporate governance issues where they're clearly not attempting to maximize the value of the company. They're just, trying to make life easy for the executives, and that's not always an optimal scenario for people. But yeah, I mean, it's a big world out there, and if you can avoid some of the worst domiciles in terms of investor protection and governance, then it's still, there's 40,000 securities to look at, and so we get busy. It takes time.
Yeah, absolutely. And there's a lot, of course, of resources if you're looking to learn about value investing and get into that space generally. For students who, let's say, think that microcaps and smaller, sort of more illiquid securities really present a really great opportunity for very outsized returns, but they're really trying to, become more educated in the space. Do you have any sort of pieces of advice for them?
Yeah, I would say that, I mean, start with Google. There's a ton of good communities out there, a ton of good blogs. I mean, reach out to me. I'd be happy to mention several. If you're a social media kind of person, finance Twitter is really, really great. The FinTwit community is very helpful and pretty welcoming for the most part. And I'm a pretty active contributor there. Alluvial Capital is the handle. But yeah, a lot of great people operating there. But yeah, I mean, just find some sort of community. I mean, we're all pretty lucky to live in an age where at the click of a button, we can be interacting with other people with a similar interest and approach, and it wasn't that way a generation ago. And so, yeah, there's just unlimited resources out there. So yeah, you can reach out to me, and I'm more than happy to point you to a couple of my favorite forums and blogs, and yeah, get you started on that road.
Yeah, I think that's really excellent. And you spoke a little bit about previously about dark stocks and how it's more difficult to now with the regulations in the US. Is there opportunities for buying dark stocks in some of these foreign markets that you're looking at, and how attractive is that to you?
Yeah, there are a couple of international OTC markets. Unfortunately, they are nearly impossible for US investors to access. For instance, there's one in Switzerland that's run by just a handful of banks. And you basically have to be a client of the bank, which I guess you can fly to Switzerland and open an account if you want to, but they're not too keen on having American investors. And so really, international OTC markets are not practical for most people, but it doesn't keep you from investing, like I said, in the junior segment, which has thousands upon thousands of companies that all the way from a couple $100 million in market value down to 3, 4, 5 million. which is doable for investors. And honestly, any online broker can get you there these days. I mean, I use Interactive Brokers for a portion of my trading, and they can easily get me into micro caps in Sweden or Italy or France or whatnot. So it's easier than it ever was before. So, go out there and try it if you want.
Yeah, absolutely. I think that makes a lot of sense. And I'm curious, are there any sort of, let's say, industries in particular that either you've avoided historically or that you've particularly found a lot of opportunities in historically?
Yeah, definitely. I definitely have some industry preferences. I would say I gravitate toward sort of the less exciting industries that nevertheless have pretty regular cash flow and are predictable and are not exciting because they don't get the buzz and the hype from investors. They can trade cheap for a while. So I guess historically I've done very well in consumer-facing companies like basic consumer goods, some industrials. Some industrials are deeply cyclical, some are less. But that's been a fun market. Telecom has been very, very good to me. Unfortunately, a lot of the small telecoms have gone private by now, but that's been a fun market. Some basic technology, things like consulting firms, software, stuff like that. It's been pretty good. I've never been all that interested in or had much luck in microcap healthcare. It tends to be a lot of companies that have sort of a speculative treatment or product, and either they do really, really well or they're just a zero. And I tend to avoid those binary outcomes. I've never done well in sort of resource exploration, junior oil and gas, things of that nature, because a lot of them, like I said, are very, very speculative, and either they strike it rich or they just bleed out over a decade. And management is pretty low quality. There's a lot of you can nicely call them serial entrepreneurs. You can more accurately call them serial hucksters in that market. And so I've never done too well there. But yeah, I mean, everyone has to find the industries that they enjoy investing and enjoy reading about. And I do work to expand my circle of competence, but at the same time, it's good to develop expertise in particular industries and work on applying that.
Yeah, absolutely. And so we spoke a little bit earlier about, let's say more traditional quantitative screeners and sort of how you use those. Do you find keyword screeners interesting, for example? I know we spoke about that company earlier where you would like sort through their filings at the end, discover that they had, they sold a $15 million real estate and their entire company is worth 16 million. Do you have sort of examples of those that you can find using keyword screeners, or are those just not sophisticated enough yet to be able to pick up on such opportunities?
Yeah, I do use those. I mean, my associate, that's one of his roles, is to kind of flag everything that comes through and kick it to me, and we'll talk about it. But yeah, I mean, just Google is a good solution for that. There's other sort of like Feedly, like go aggregate news items and things like that. And you can do full text searches on the SEC's Edgar system, and you have to generate your own list. The stuff like sale and leaseback is good for capturing property sales, things like that. Acquisition, tender offer, things of that nature are really, really good. Yeah, I mean, I have a whole list. Unfortunately, I can't share all the secrets there, but there are keywords that whenever you see it, it's not a guaranteed opportunity, but it gets my antenna up. It's something I look at.
Yeah, absolutely. And can you speak a little bit more about how you analyze management, please?
Yeah. One of my sort of fundamental beliefs is that good management will keep doing good things, and bad management will keep doing bad things. I rarely see a case where a management team that has a history of good stewardship, a history of fair compensation, a history of value creation, suddenly turns around and pulls the rug on everybody. And I rarely see a case where management that has a history of self-dealing, has a history of diverting assets, has a history of failure, suddenly turns it around and starts behaving ethically and according to their fiduciary responsibilities. I rarely see that. And so track record is really, really critical. Track record and incentivization. I mean, I want to see a case where if a stock price goes from 10 to 25, that management makes a ton of money. If management doesn't make any money, if the stock goes from 10 to 25, then what's their motivation really? I mean, they should be motivated because they're getting paid to do a job, but let's be real. What motivates these people in a lot of cases is getting rich. And so I want to see management that owns shares. I want to see management that's compensated for making money for shareholders. And I want to see a case where management will be better off in the long run by increasing the share price than by increasing their salary. I mean, I want them to be paid fairly, but I don't want them making the majority of their wealth from salary and benefits. I want to see them making money from shareholders making money.
And speaking more about, let's say, management's track record, I mean, how difficult is there? A lot of times where like you look at these companies and you're trying to find that out, and it's just, there's very sort of limited information on that because let's say the management are relatively more brand new, or the company is, small enough where management hasn't really been followed before, those types of things.
Yeah, I mean, there are cases like that. It's easier than it used to be. I mean, most people are a Google search away, and you can know where they went to, where they grew up, where they went to college. If they've had executive positions before this, you can see that. But honestly, that's just a question for management. Hey, where were you before this company? What was that like? Why'd you come over here? What are you trying to do? Sometimes the answer is great. Sometimes it's like, why are you here? I don't really trust that you're here for the right reasons. You just weren't ready to retire and you wanted the last easy gig. That's not a good reason for me to invest in you. And so, yeah, it's not really that hard. But in cases where the record is a bit spotty, that's just a conversation.
Yeah, absolutely. And maybe speak a little bit about how you initially became interested in investing in general, and also how you initially sort of became interested in looking at the space and more and less liquid securities.
Yeah, totally. I would say I caught the investing bug pretty early. I was a young teenager in the late 90s, and my dad was a lifelong UPS employee. And they went public in, I think it was 1999. And he, of course, like had a lot of stock, being an employee since the 70s. And all of a sudden, he kind of had like a comfortable retirement looking at him. I was like, that's kind of amazing. You're telling me that I can buy something and I'll do nothing, and then maybe 10 years later, it's worth a lot more? That's like the opposite of everything. Like I go buy groceries and a week later, they're gone or they're worthless. But I can buy stuff and it's worth a lot more down the road. It was like a revolution in my mind. And at the time, late 90s, like the internet bubble was like in full swing. And it seemed like anything you could buy that had a .com on it or some kind of connection to the internet was just, up 30% a week, day in, day out. And I was like, this is crazy. This is the easiest way to make money in the world. All you have to do is buy NASDAQ stocks and you tripled your money in a month. And of course, it turned out that that was illusory, and it all went away pretty quickly after that. But nonetheless, I was fascinated. And so, like I said, I went to college for finance. As soon as I was able to, I opened up a brokerage. Like I think it was Scottrade, like $1,000 in my like summertime job earnings, and I had no idea what I was doing. Like I bought my first stock, and I made like 5% in a week, and I sold it. I was like, I'm a genius. And then I lost all my money on the next stock, of course, because that's something that should happen to everyone at some point. I think it's the worst thing that can happen is too many of your stock picks are good right from the start, because then you don't learn anything. But I mean, I knew I wanted to do investing, and sort of a little later on, probably 2008, 2009, I started getting really, really interested in sort of the small stuff, the oddball stuff. I'd read some academic studies that said, like, in the long run, if you want to bias your return outcomes in a positive direction, and you're willing to stomach the volatility, that small companies, less liquid shares can be a really attractive place to put your money. And that sort of jive on my own personality. I've always been the kind of guy who enjoys a treasure hunt. I used to spend time like in thrift stores looking for vinyl records and stuff like that. And I just love turning over rocks and digging up treasure. And that's sort of what the OTC markets are, and small caps, micro caps, forward stuff. It's a treasure hunt, which I've always enjoyed. So yeah, it was a natural fit kind of personality wise.
Yeah, absolutely. And you mentioned that liquidity premium that you stumbled across. academically in studies, and you say that's greater than, for small caps, great for other things. What has that tended to be in academic studies, the liquidity premium? What is it about?
Yeah, I'd have to double, triple check the exact
Okay.
figures, but I think it's been in the neighborhood of 5% annually. The
Yeah.
spread between the most liquid decile and the least liquid decile. And it just sort of made intuitive sense to me. I mean, you can debate about the value premium, maybe value companies were just underpriced for a long time and maybe that's gone, or maybe they really are riskier. Same thing with size. I mean, small caps were likely underpriced for most of the 20th century. Maybe they're not anymore. I don't know. But intuitively and logically, to me, the illiquidity premium made the most sense because these most illiquid stocks are just not investable for large pools of capital, and they never can be, just by the definition of large pools of capital and the definition of an illiquid stock. So I think that premium has is the most robust and has the highest chance of being maintained in the future.
Yeah, that makes a lot of sense. And we spoke previously about several cases of investment successes you've had in the past. Maybe speak about a few cases where your thesis didn't play out, the investment did not do well, and what you sort of learned from those opportunities.
Oh yeah, I mean, there's been a few of those. One is sort of an ongoing case of mine, which I very much do own. It's a company called Eversell. EVRC is the ticker. They trade over the counter. They were a dark stock for a long time. They'd recently published their financial statements for the first time. They're sort of an investment holding company where they were pretty opportunistic. They would just find an attractive investment and invest and hold it for a few years and then sell it. They've actually been very successful on the investment front. About everything they've done has worked out very well for them. They owned like a thermal printing company in Malaysia for a while. Did very well on that. They bought into a software as a service company called SharpSpring. They did a convertible note. They made a ton of money on that. And then just recently, they bought out, in conjunction with others, they bought out a cell phone accessory company called Zag, which does like protective covers, like I have one on my phone. It works great. But they did a buyout on that. Problem is the corporate governance has been terrible. They fired their CEO. They're in a fight with him over whether they have to buy his shares back. He always had like a performance carry on some of the investments they did that was poorly disclosed to investors. And it was just a case where this company should not have been public. They wanted to be a public company that was run like a private company, and that just does not work. If you're a public company, you have a certain amount of responsibility to be transparent and timely in your reporting and to dialogue with your investors, and they just don't want to do that. And so it's actually incredible. Shares were last traded like 165. They have like $1.47 in cash on the balance sheet, no debt, and the remainder of the company is like probably worth 60 to 80 million, but it's trading at like the stub value is like 8 million. So I continue to think it's going to work out great, but I've been really disappointed with management to this date. I mean, not a buy recommendation, do your own due diligence, but I hold it. It's been very disappointing over the time that I've owned it.
Yeah, absolutely. That makes sense. And actually, speaking about buy management, I want to sort of bring up another question, which is, now there's a real sort of, I think, issue if a company does become a dark stock, because you just see a lot of times, the stock price will just plummet, not necessarily for another reason, but just because it basically becomes, impossible to buy. And so there's just heavy selling pressure, and people, just become, sort of very afraid of holding it. How do you sort of evaluate that? Or let's say some of these companies who are probably liquid, who probably don't have that many shareholders, who may be close to, I think there's, I forgot what it is, but there's a certain sort of amount. But if you have less than that amount of shareholders, you don't have to report anymore. How do you sort of evaluate the risk of that?
Yes, that is, of course, a risk. If you have an OTC company, you could always stop SEC reporting and stop providing updates, and then it goes dark and the shares get really liquid if it's a bad scenario. But that's sort of where management evaluation comes in. You have to find, it's not the companies with management that regards shareholders as partners and treats them fairly and communicates it is working for them. They don't do that. It's companies that treat shareholders as the opposition, as marks, that end up doing that. And it has happened to me more than once where, just like you said, You have a management team that treats shareholders as a nuisance, wishes they would go away, and realizes they can get them to go away if they stop reporting and go dark and get illiquid. And that's the sort of outcome I try my hardest to avoid anymore. I think I got hit with it a couple times when I was a younger manager. I try to avoid it now, but yeah, that's where the quality and the ethics of the people you're invested with is paramount, because yeah, there are ways to take advantage of your investors if you want to. And the SEC made it easier for them by bargain trading in these dark companies. And yeah, you don't want to invest with people who would do that to you.
Yeah, absolutely. And I think for our concluding question, what are the most influential events of your investing career?
Oh man, it's got to be the macro stuff. I mean, there's been times in my 8 years as a manager where the market is just in like full on freak out panic mode. And sometimes it's justified, sometimes in retrospect, the fears were overplayed. And maybe the macro events in question doesn't even have a negative impact on your companies, but your shares will fall anyway. It does not matter. When fear rules the day, your shares are going to take a hit. I mean, like early 2020, when COVID headlines were like just exploding everywhere and we had no idea what was ahead of us and for how long the economy would be shutting down or whatnot. I own shares of this company, still do, called LICT Corporation, which is a rural telecom. And shares in the course of like a month went from like 20,000 to like 12,000. Which made absolutely no sense, because if everyone's home, everyone needs internet. If anything, COVID was a beneficiary for that company. But because the shares were illiquid and people were trying to get liquidity wherever they can, they were selling the shares at whatever price they could get. And it went down like 40% in about a month. And that really hurt. But that's a reason you hold some cash. You always need to have some cash around to take advantage of those situations. I was able to buy shares in a property company that gapped down from like 20,000 to 13,000 for one day. I was able to buy a couple of shares that day, and I wouldn't have been able to if I had no. The market is doing great. Cash is trash, right? Like, you could have been making money. It feels bad to hold cash, but having some cash around is what saves you when the market is just in pure panic, free fall for good reason or not. But yeah, those markets are not fun at all, but everyone goes through them. The important thing is you have constructed your portfolio in a way that lets you get through to the other side.
Yeah, absolutely. I think that makes a lot of sense. And actually, that just brought up one more question I just want to ask real quick.
Sure.
Do you have, so I'm guessing, let's say you look at a company, you say, okay, this company has sort of assets that are worth, let's say, $20. Today, the company is $30. Do you sort of have sort of alerts on a lot of companies that basically say like, okay, if the stock price falls below like 20, basically alert me. And then, you can take a look at it again at that point to see if it's, yeah.
Yeah, definitely. I mean, I have a lot of stocks that I think are, I like this business. It's good quality. It has a good future ahead, good people in charge, but the price does not excite me right now. I mean, yeah, maybe it's 30, but I'll say, okay, it's $30, maybe it's worth 35. I'll get really interested if the share gets to the low 20s. And so I put it on my watch list. I check in on a weekly or something, and maybe I set some kind of alert that pings me if we get to a certain level. But yeah, I mean, that's an important part of managing a portfolio, I think, is not only evaluating your current investments, but having a roster of securities that could get into your portfolio at the right price, and being ready to act if that price is reached.
Yeah, absolutely. Thank you so much. This is a really tremendous session, and I really appreciate you taking the time out of your busy schedule to speak with us today.
I appreciate it. Thanks so much.
Excellent. Have a great day.
You too.